Okay, so you want to own an apartment building, a real one, with real tenants, real income, and a real number attached. Picture it, a mailbox stuffed with rent checks, arriving like clockwork on the first of the month. Your name sits quietly on a deed, filed away in a county office nobody ever visits. The tenants wave when they see you in the lobby. They never see the spreadsheet behind the wave. There's a version of this where you sit on a porch with coffee. A building 3 states away just pays you, every month, without asking permission. You picture yourself walking the halls with a clipboard, nodding at repairs already scheduled. You picture the building outliving you, still paying your kids after you're gone. Every real estate seminar sells some version of this same daydream. Buy brick, collect rent, let time do the rest. The daydream is old. That's exactly why the industry never has to update its pitch. The daydream is honest, as far as it goes. It just never mentions what's underneath the mailbox. Sounds simple. It is not simple. Here is the first number, and it lands before you've even sat down. A 20-unit building generating $120,000 a year in net income, priced at $2 million, is a 6% cap rate. Memorize that fraction. It is the entire industry compressed into one number, and it is about to explain everything that happens to you next. You do not buy an apartment building. You buy a fraction. Price divided by income equals the cap rate. The cap rate is the whole negotiation, disguised as a single percentage. Everything else, the brick, the lobby, the little garden out front, is set dressing around that fraction. In 2026, apartment cap rates are averaging 5.7%. That number has held steady for 7 straight quarters, the longest plateau in 25 years. Stability sounds comforting. It is actually a signal. Buyers and sellers have stopped arguing about the price of risk. Class matters more than the rest of the deal combined. Class A buildings, newer, better located, trade at a 4.74% cap rate. Class B compresses slightly to 4.92%. Class C, the older and rougher stock, sits at 5.38%. Here is the mechanism under those numbers. A lower cap rate means a higher price for the exact same income stream. 2 buildings can generate identical rent and sell for wildly different amounts, purely on the buyer's confidence in the neighborhood. Confidence, in this business, is really just a bet on the future. Which block gentrifies? Which school district improves? Which employer stays another decade? You are never pricing bricks. You are pricing a guess, wearing a suit. The 7-quarter plateau hides a quieter argument underneath it. Buyers and sellers have simply agreed to stop testing each other. For now, on a number neither side is confident enough to move. New construction skips the cap rate question entirely. It goes straight to raw cost. Mid-rise apartment buildings cost between $200,000 and $400,000 per unit to build in 2026. Before land, before financing. Location multiplies everything on top of that. A 50-unit low-rise community in a Texas suburb might come in under $15 million, start to finish. Put the same 50 units in central Los Angeles. The bill can exceed $40 million. Same blueprint, same unit count, same elevator, same lobby, same number of parking spots. Different zip code, the number more than triples. Financing adds its own toll on top of the sticker price. HUD apartment loans are running around 5.42%. FHA loans sit at 5.44%. You are never just borrowing money to own a building. You are financing the gap between what it earns and what it costs to hold. That gap is the whole game. Borrow at 5.4% against a property earning a 5.7% cap rate. The margin between the two numbers is your entire profit before a single repair bill arrives. Shrink that gap by half a point. In either direction, the deal that looked comfortable on the tour becomes a deal that barely survives its first bad quarter. Add closing costs, loan origination fees, appraisal fees, add a capital reserve the lender will insist on before releasing a single dollar. The number on the offering memo was never the number you actually need in the bank. Every new buyer discovers this at the same moment. The day the closing statement arrives, the total is somehow larger than the price they agreed to. Here is where it gets interesting. None of these numbers describe the building, they describe a bet. The market's collective guess about what this building will earn next year and the year after that. The sale price isn't what you're buying. You're buying somebody else's guess about next year's rent. You never buy an empty building. You buy every lease already signed inside it, whether you've read a single one or not. Those leases don't expire the day you close. The tenant who has lived on the 3rd floor for 11 years keeps her rate, keeps her renewal terms, keeps her legal standing. None of it resets because the deed changed hands. In Los Angeles, Any building constructed before October 1, 1978, falls under rent stabilization, and that ordinance just moved the goalposts. A new formula takes effect on July 1, 2026. It cuts the maximum allowable annual rent increase from 8% down to 4%. Read that again. An owner who underwrote this deal expecting an 8% ceiling now operates under half of that number. By statute, in the middle of their hold, no vote, no negotiation, no grandfather clause for the price they already paid. Older buildings carry a second, quieter inheritance. Infrastructure that was never designed to last this long. Outdated electrical panels don't schedule their own failures around your cash flow. Insurers have noticed this pattern faster than most buyers. Legacy wiring and aging systems get flagged as elevated risk that either raises the premium or ends coverage altogether. A second bill, hidden inside the first one you thought you already priced in. None of this